Hello and welcome to another episode of Investment Acorns, our exclusive series featuring insights from WhiteOak Capital Asset Management Limited. Joining me today is Aashish P. Somaiyaa. He's CEO, WhiteOak Capital Asset Management Limited. Welcome, Aashish.
Hi, thank you. Thank you for having me, Ruchira.
Good to have you back with us. Now, let's begin today's conversation with your column, Managing Portfolio Risks Amid Macro Uncertainties in Wealth Insight January 2025 issue. So you mentioned that many investors are preoccupied with macro predictions, be it political shifts or global developments. So why do you believe this approach falls short, and how can they shift focus to what's actually within their control?
Basically, what happens is that whenever we travel, I've been in the industry for now nearly 25 years. And one of the key parts of my role, apart from managing, operations and service, compliance, and, so many functions that one has in an asset management company. One of the key roles is also to travel and meet investors and meet mutual fund distributors, advisors, wealth managers within India, sometimes outside. So in all of this, what happens is that a permanent feature of all these meetings is, people asking that what do you think is going to happen in the markets? And it is always prompted by some or the other macro development, right? See, sometime back it was, what will happen if NATO admits Ukraine into their fold,
Yeah.
And if you go back, like 30, 40 years, you go time immemorial in history, what you will realize is that there has always been some or the other topic to discuss and worry about, correct? And still, the Sensex or the Nifty has been, inexorably just climbing up, up and up. And it is a well-known phrase that markets always climb a wall of worries. Also, the other important point is, that let's say that if I were to meet you and let's say you are my investment advisor, and if I ask you, Ruchira, what will happen to my portfolio if Mr. Trump becomes president and, if he changes some things about tariffs and about policies? Now, look, if my portfolio is out of balance in terms of its asset allocation, right? If my portfolio is fully dependent on, say, small caps and mid caps and thematic funds and sector funds, then basically you will surmise that my portfolio has a high beta, it has a high volatility, right? And my portfolio has been created in a way that it cannot withstand any volatility in the market. First sign of trouble, and it will actually exhibit large volatility on the downside. So the obvious point is that, look, if your portfolio is out of balance, if you have a highly volatile portfolio, you are standing on an edge, and then you are saying that what will happen to my portfolio if XYZ ABC plays out. I mean, I always tell people on a lighter note, my son is 5 years old. Okay. And I'll give you one instance which will explain to you what exactly I'm saying about markets and investors. So, the people who take care, make food at home and take care of my son, they belong to eastern part of India, Siliguri and Bengal and Nepal border. Now, you know that, when you say you eat momos or noodles, these part of the country, they eat very, very spicy food, right? You must have had those red chilies and those kinds of things. Now, once I saw that, they were having those noodles which were extremely spicy. And there is a video of my son insisting to the maid that, I want to eat these noodles. So she said, beta, it's not for you, it's too spicy. He insisted on eating it. And then he started crying the moment he ate it because it was very spicy. So they took away the plate from him and said, okay, see, you're not supposed to eat this. But then he is insisting on eating it. So, he's crying also and he's eating those noodles also. Now, obviously, we are not here to discuss my son, but you can imagine that, what do investors do? When it comes to investing, they don't practice asset allocation. They want highest possible return. In the last 1 year, if you see Amphi data, all the money actually has gone to thematic funds, sectoral funds, small cap, mid cap, multi cap, right? Now, you are eating, मतलब आप तीखा खा भी रहे हो और रो भी रहे हो. So, you're worried about markets, but you're not willing to do anything about your asset allocation and where you're investing. So it's that kind of a situation. That's why I say that, there's too much discussion about what will happen in the markets rather than thinking about what is in my portfolio and how it will actually react.
Right. So the natural question, the next question is, you've also written that the risk is never in the market, it's in your portfolio. So what are some practical steps that investors can take to make their portfolios more resilient to unexpected macro shocks?
See, I think first is that, everybody overestimates their risk appetite. And, there are times when they underestimate their risk appetite. So, but those are very few times. Given that markets have rewarded people handsomely in the last couple of years, there has been extreme volatility, but with every volatility, market has bounced back sharply. Let me put it that way. And that starts, that makes people believe that, okay, I mean, this fine. We are making 20-30% compounded return. And, volatility, I can tolerate volatility. I have seen volatility. But, people haven't seen any period where market remains where it is for 6-9 months and, really tests patience. Correct? So what I've seen is that generally people feel that, I can manage risk, I can manage volatility. I have seen enough, but you haven't seen enough till you actually your patience gets tested. So what people need to do really is that they need to practice asset allocation. They need to understand their risk appetite more in terms of need for liquidity, more in terms of situational thought process. That okay, if 100 becomes 80 and remains there for 12 to 18 months, then what will it do to me? They need to think back how they felt in March 2020. They need to think back how they felt in May 2022 when Nifty suddenly fell to 15,200, oil went to $130, etc. Right? So you need to revisit how you felt at each of those junctures when your portfolio was down 20, 30, 40%, right? And then think that how would I have reacted, not if it bounced back, how would I have reacted if it remained there for, 9, 12, 18 months, correct? So people need to do some scenario analysis in their own minds and not assume that this is how the market works, 20, 30% compounded is the way it should work, etc. I think those are wrong beliefs. We should be open-minded and we should think how we will react if there are surprises. The other important thing is, always to keep in mind the base rates. The base rate is that over 30-32%, over 30 to 32 years since India's market liberalized, the long history is that Sensex compounded 14%. So 20-30% is not the base rate. It's not the order of the day. The second thing, if you take another example of base rate, if you take the entire market capitalization, on an average, 65 to 70% of our market is large cap. 70-80% of our market is not small cap and mid cap. Pareto principle is very much at play. On an average, 50-60% of our market and earnings component is bank, IT, pharma, consumer, these big sectors. It's not PSU, defense, railway, and infrastructure. Correct? But see, in the last 3 years, everybody's portfolio is cyclical, high beta, PSU, railway, infrastructure, small cap, mid cap, energy, utilities, right? So you can see that everybody's portfolio is away from the center of the market. Everybody has lost sense of base rates and lost sense of balance. So you need to align your portfolio more where you're more accepting of the base rates and the long-term trends and not start believing that, PSU is probably 10-12% of the entire market.
Right.
Right. The market is, defense, railway, energy, utilities, these are not like 30-40% of the market. Correct. So what is the base rate? Where is the market and where you have been allocating? Is your portfolio in the market or in some corners, cracks and crevices of the market, operating in some tiny sliver? All of those things people need to be mindful about and bring the portfolio back to the center.
Right. Like you said, people underestimate their risk appetite. Many portfolios today are heavily tilted towards cyclical, small, mid-cap stocks. So what are the early warning signs investors should look out for to rebalance in time?
So, Ruchira, it's already evident. See, look, if you look at, say, last 6 to 7 months, like the market had a big crack when the election results came, and then the market recovered. Okay. While market recovered, one thing I don't know how many people have noticed, but in the last 6 months, the market hasn't fallen as much. Market even recovered, and recent times there is a correction. But if you take 52-week high, from 52-week high, Nifty, small cap 250, mid cap 150, all of these are said 11, 12, 13% down from 52-week highs. That's not much. I mean, every year such a bout of correction happens. But what people should notice, while the Nifty, small cap, mid cap, all of that is 11, 12, 13% down from the peak, the so-called consensus sectors like defense, PSU banks, PSU, energy, utilities, they are 25 to 30% down from their 52-week highs, right? And in the same time frame, the non-consensus sectors like say pharma, IT, they are up 20, 30% from their bottom. Like everybody thinks that financial services and banks, not much is going to happen, but they have massively outperformed. The financial services index hasn't fallen as much in last 6 months as some of the other so-called popular uh, sectors. So these are clearly early warning signs on your question that everybody is thinking about correction. There's not so much of a correction. It's more of a very violent sector rotation that has actually played out in last 6-7 months. So these things tell you, how things are changing. In the first few days of this correction, like in the fag end of 2024, large cap was underperforming. Large cap was falling more. But last few days, small and mid cap has fallen more and kind of wiped out the deficit completely. Now everything has fallen as much. So these are signs of, where there is relative value and how the market is shifting signs.
You also pointed out how investors take comfort in post-event explanations, even though they're too late to help. So, how can they move from reacting to events to managing their portfolios more proactively?
So, I'll give you two examples of this very interesting thing. See, I'll give you an example. First example, uh, in the last 4 or 5 years, we've seen very violent, if you look at mutual funds, we've seen very violent rotation of best performing funds, fund managers, and fund houses, right? If you see uh, before ILFS default, before COVID, it was more you saw more growth oriented. Wherever you had growth, those were the funds and fund managers and sectors that were actually doing very, very well. So, mortgage finance, NBFCs, low interest rates. So, NBFCs did well. Home finance did very, very well. Because rates were low, liquidity was high, small cap, mid cap did very well. So anybody who had these kind auto ancillaries, these kind of things were doing very, very well before ILFS default. Then you saw 2019-20, it was more about defensive quality. And when COVID happened, it became very clear it was all consumer, FMCG, digital companies, pharma companies. So it was quality. So first growth, small and mid cap. Then quality did very well. Small and mid cap did badly. Then come 2021, small and mid cap started firing up in a big way. And instead of quality, it was more cyclical, value, those kinds of, policy driven sectors, macro driven sectors, those things outperform. Correct? So in the last 4 or 5 years, you have seen massive churn in terms of best performing funds, best performing styles, best performing fund managers. Correct? And then, as a result of this rotation, people have become more conscious to the fact that when different factors, change in the market, growth, quality, beta, size, meaning large cap versus small cap, so now what people think that, okay, it seems that certain factors are driving performance. So, we should do more factor-based investing. Let's buy more factor-based funds. Now, this is the first example of a fallacy. What happens is that human beings, all of us, when we learn something, that, oh, this is the cause and effect. Okay. When we learn something about it, we don't just store that information. We think that, okay, this is how the world works. So now let's do this. See, just because you have understood that some people were getting outsized alpha because of inherent factor bets in their style of investing. So understanding doesn't mean that this is how it will play out in future and this is how you should. It only means you have understood the past. It doesn't mean that you have got the capability to predict the future. In fact, my understanding or my learning is that predicting which factor to bet on is as complex as forecasting markets. Predicting which factor to bet on is as complex as picking the right fund manager. If I were to draw any inference out of this, I would only draw one inference, that when suddenly some fund manager or fund house goes number one on alpha, suddenly from nowhere, like rise like a phoenix, it only tells me one inference, which is that people who have outsized exposure to certain factors, they suddenly become number one. And people who have outsized exposure to certain other factors, they suddenly become number 20. And people who have a broad, balanced portfolio, they don't swing as much for the extremes. So the learning is about consistency. The learning is not that you should be in the right factor at the right time. So what happens when people understand the past, instead of storing that information for processing, they start, very quickly to jump to conclusions that, okay, now let's identify which factor will work. The learning is not that factors have always been driving performance. When macros change, which factor is at play will change. So you're not going to be able to predict which is the next factor to play. The only learning from that is that you should not be having outsized factor bets, because it infuses a lot of inconsistency and volatility in performance, right? So that is one thing. The second thing I've seen, which is related to this, is that, when people get a good explanation or understanding of the past, they feel that they can sleep comfortably, they feel peaceful, and, they just, it's just a closure in the mind. But that doesn't mean it's going to change your performance or improve your portfolio, right? Again, another example of drawing wrong conclusions. So let us say that you can see now that the dollar is, appreciating significantly, rupee is depreciating, it is infusing a lot of volatility in our markets. And, you can see that suddenly 26,200 on Nifty, in a matter of 2-3 months, we are down about 12-13%. So what will happen is that somebody might think, oh my God, we were supposed to be on a roll. I was reading predictions about Nifty becoming 30,000. Why is it we are going in opposite direction? So then some, talking heads will be trotted out to give explanations. And then they will say that, okay, yes, we deserve to be 30,000, but temporarily, Trump transition, blah, blah, blah. We are expecting dollar to appreciate. We are expecting China to devalue the currency so that they will overcome tariffs. And India also has to have a competitive devaluation, otherwise we'll become incompetitive. So, all these explanations will sound very smart, but they are what they are. They are post facto explanations. Now, what happens is that when you give somebody a sound explanation for what is happening, they get impressed, right? And they themselves feel empowered, and they themselves feel knowledgeable about it. And then that understanding of what is happening makes them believe that they can negotiate the future better. The only way to negotiate the future better is to follow asset allocation and make sure your portfolio is not sticking out in any direction or any corner of the market. Explanations are only to make you feel better, but explanations don't improve your performance, right? So whether it is factors or macros, whenever something plays out, very good explanations are given. Those explanations make you feel better. They make you feel empowered. They make you feel that you understood what is happening. But none of us should be under the illusion that just because we get a perfect explanation of what happened in the past means that we are going to be able to negotiate the future better. The future is always going to be uncertain, and uncertainty can only be overcome by right asset allocation.
Right. You also compared portfolio management to sticking to a football formation, stick to your formation and play the strategy, you said. So could you share practical advice for investors to maintain discipline in their strategies, even during turbulent times? Because it's easier said than done, that stay calm and, carry on. But how can one do that really?
See, I think, we spoke a couple of times about asset allocation. Like I said, the only way to negotiate uncertainty is to do asset allocation, right? And why a football team has a particular formation? Because you cannot be too deterministic. You can only be deterministic about what you want to do, but you can't be deterministic about how your competition will respond or what their strategy is. You can be deterministic about your own strategy. But isn't it obvious that if your competitor overwhelms you with their strategy, then you need to be flexible, you need to go back to the drawing board, you need to rethink, and you need to approach the game differently. That is why there are breaks and half times. Correct. That's why now you look at portfolios. Correct. So if I say, a lot of times, now I'll give you an example. There is a fund we manage which has, like significant exposure to gold, like say 20-25% exposure to gold, 20-25% exposure to equity, and say rest is fixed income. Just giving you example. Now, many times when people say that, okay, how is your fund currently allocated? So I tell them, okay, 20-25% gold, blah, blah, blah. So they will come back and say, but don't you think gold has really run up a lot? Why do you still have 23% in gold? I think gold is going to come down now. It's already done what it had to do. So then, what is the fallacy in this question? You're doing asset allocation with a predetermined thought process that gold is going to do badly. So then make it zero. Then don't do asset allocation. Put all your money in equity. Right? So see, asset allocation can never be practiced, or a open-minded strategy that, okay, this is my strategy, but if the competition throws this at me, this is how I will rework. Right? All of this, whether it is asset allocation or responding to a competitive landscape or responding to your opposing team, all of this can be done only by open-minded people. People who are deterministic. See, like, when you look at an asset allocation product, and if your first question is that why are you holding 23% gold, correct? That means you are not somebody who is open-minded about asset allocation. That means you are deterministic that gold is going to go down, so then equity is going to go up, right? The point of asset allocation is that you're not concerned with the performance of any one asset class. You're only concerned with lack of correlation or cushioning of volatility amongst asset class. I mean, they just have to behave in an uncorrelated fashion. So why do you have gold and equity both in your portfolio? Right? Because there will be times when equity will disappoint, correct? And your portfolio will run the risk of falling 20, 30, 40%. At that time, generally it has been observed that gold doesn't fall or even might act as a volatility dampener in your portfolio. Now, what is the importance of dampening volatility? You may be very deterministic, you may be very bullish, and you may be, all of us are thorough believers in Amrit Kal. There's no question that we are not going to see it. We are going to make it happen. But it's not going to happen tomorrow morning, and we're not going to get there in a straight line. Every year from the top, market falls 15-20%. Is it necessary that my portfolio also should fall 20% and go with the vagaries of the market? There are techniques available whereby you can dampen the volatility, and if you dampen the volatility, it will ensure that you don't react emotionally. See, everybody says be greedy when others are fearful, be fearful when others are greedy. ये theory है, बोलने के लिए अच्छा है, but ultimately, yeah, easier said than done. But if your portfolio falls, I mean, in March 2020, everybody was fearful, correct? So what happens is that it's very important to dampen volatility of portfolios, because if you do not dampen the volatility of a portfolio, which can only be done by open-minded people, by the way. People who are deterministic, they don't cater to all of this. Why it is important to reduce volatility in a portfolio is because if the volatility is fully exposed to volatility, then it will go for the extremes. And what I've seen is that when you expose people to extremes, that's when their emotions come out. See, greed is an extreme emotion. Fear is an extreme emotion. Envy of your neighbor's returns is an extreme emotion. Correct? All these extremes come out. All these emotions come out only when portfolios are exposed to extremes. And when emotions come out is when you make mistakes. So the best is, however deterministic you may be, the best is you make sure that you don't invest in a way that the market vagaries will bring out emotions. Because if your emotions are exposed, you're highly likely to make a mistake.
Right. Now, moving on to your column in Mutual Fund Insight, February 2025 issue, Markets, Mindsets, and the India Story. We've seen an incredible surge in SIPs and trading accounts during this market cycle. So what do you think has fundamentally changed to drive this explosive growth in investor participation?
See, I think, there is always if you go by commentary, television, the news, and, general chit chat, if you go by commentary, a lot of people seem to think that, yeah, stock market is booming. So it is drawing in a lot of people into the industry. And, everybody seems to be attributing it to cyclical phenomena. Because it's true that when the markets are making headlines, when the markets move from economic times to the tabloids, correct, it draws in or sucks in a lot of people, correct. But I would say that, what has happened in the last few years is that the India story or the demography that we have been talking about since time immemorial, that demography is actually now playing out, right? Because the way our population pyramid was shaped 10, 15 years back, most people in India were teenagers or kids. And today, finally, you hit a inflection point where most people in India are, between 15 to 35. We are in the late teens or the youngsters, correct? You know that the median age is nearing now 30 or maybe just a bit lower than 30, right? Which means that we are all in the prime of our, as a country, we are in the prime of our youth. So what is happening is that while the normal tendency is to ascribe this, huge influx of investors, normal tendency is to ascribe it to cyclical phenomena. But apart from that, what we should also understand is that it's just that there are so many people who are participating. It's just the sheer number of people. And plus, for all this large number of people, the number of options available has systematically gone down. Look, even if there were so many people 20 years back, they wouldn't have come to capital markets 20 years back, because 20 years back, our interest rate structure was such that the government of India was, I remember when I started my career, RBI used to issue bonds on behalf of the government. They will call, GOI relief bonds. That was paying some 11-12% tax free. So what happens is, if our demography was such that even 20 years back, we had so many people. 20 years back, most of us were kids. We didn't have so many people. But even if for a moment we thought that we are 15 years back, 20 years back in our demography, then those people would have been doing fixed income, because, post office gave 10%, State Bank gave 10%, HDFC and Bajaj and Kotak and all these guys were borrowing, NBFCs were borrowing at 16-17%. But today what has happened is not only the demography has changed, people have come of age, but fixed interest rates have come down dramatically. Habits have changed, right? Technology has changed, regulation has changed, digitization, correct? So today, even if today all these youngsters, if you tell them, beta, go to the post office, it will give you 11%, they will not go. They will say, iska UI UX bahut kharab hai, correct? So, I think that it's not just cyclical phenomena. It's not just stock market performance which is driving these people. Last thing I'll tell you is that today's youngsters, their education level, knowledge, information, risk appetite, aspirations are very different from what it was 20-25 years back, right? So I think it's a lot of it is structural, why so many people are, and I think it is here to stay. There'll always be some people who will be motivated with market performance and some who will get demotivated if markets did badly for some time. But largely it is structural, and we should get used to seeing and more capital market participation.
Now, you've highlighted a common bias where India's current growth is often attributed to cyclical factors rather than structural shifts. So, how can investors distinguish between the two and, avoid being swayed by short-term narratives?
Yeah, see, because that's what see what happens is that everybody, since 20 years back, and the benefit of being in a capital market linked industry like mutual funds is that, you generally, we end up meeting a lot of people who follow the economy very closely, or, who rightly or wrongly even make predictions about the economy. Some of them are right, some of them are wrong, but all this talk about India's demography and Amrit Kal and, period of high growth, I think that is grounded in some maths and some science, grounded in economics, right? Now, this has been predicted since last 20 years. Being in the industry, since 20 years, I have been seeing reports and presentations and, future forecasts or prognosis or hypothesis of investing, saying that, demography will change. We will move from existential consumption to premiumization of consumption. And, we will see this per capita income changing, etc. All of these have been spoken about and forecasted since 20 years. But now when it is happening, people are not able to recognize that this is the shift we were talking about all along. I think that's the key thing. It's one thing to forecast. It's another thing to be alive to it when it is actually playing out.
Right. Okay. You were talking about India's demographic advantage, and so the young and growing population, it's a key driver of long-term economic potential. How can investors position their portfolios to capitalize on these demographic tailwinds?
See, I think my sense is that one is it applies to the equity market at large, right? What is most important first is to participate in the growth. The only way to participate in economic growth is to participate in equity as an asset class. The second thing is not to be flirtatious, because what happens is that if you see 15-20% appreciation, or you see a couple of years of great performance, and then you start fiddling with, okay, this is already run up a lot, let me book profits, we'll re-enter later. Or, my neighbor is getting more return, I'm doing mutual fund, this guy is doing FNO, let me do that, let me take shortcuts. So first is to participate, and participate meaningfully. Second is to participate without distraction, without flirtatious behavior, participate on a consistent and sustainable basis, right? I always tell people that, forget about future and Amrit Kal, and forget about the journey in future. Just understand one thing. In the last few years, when India was going from nowhere, from a frontier economy to just about a developing economy, in 31 years, 32 years since our liberalization, Sensex has compounded 14% CAGR. Imagine. Now, when that was the situation, no technology, no infrastructure, no sophistication in capital markets, right? No private sector so-called to speak of. It only came up in last 20 years, right? Still, it is 14% compounded over 32 years. So if you hadn't done anything in the last 30 years, your money should have doubled every 5 years. That is the rate at which we have grown. I would say our next few years, not in terms of returns numbers, but our next few years as an economy, as a country of people, I think our next few years are going to be better than in the past. So first is to participate. Second is to participate meaningfully. Third is to participate consistently. I think that is something which is very important. Now, if you were to talk about sectors, I think the biggest impact will be seen in financial services, in consumer, and manufacturing. That is my sense.
Okay. You've also spoken about the tendency of older generations to underestimate the capabilities of the younger investors. Could you elaborate on this bias and its implications for investing mindsets?
So, see what happens, Ruchira, for people in our industry. Like I'm in the mutual fund industry for now 25 years. And one of the things in mutual funds, wealth management, insurance, in all of these industries, it demands experience. It demands track record. Correct? So what happens is that more often than not, people at the helm of affairs, when it comes to wealth management, investment advisory, investment management, in a lot of these professions, because of want of experience, track record, qualifications, so many things, the people at the helm of affairs are, generally in their 50, 45, 50, 55, right? But our clients, bulk of our clients, like I can say for myself, for our firm, I think north of 50% of our clients are below age 35 right now. Because that's how the demography is changing. I'll give you a simple example, Ruchira. If I told you 20 years back that XYZ person is extremely rich, successful businessman, what age would it strike in your head?
50, mid-50s.
Right? So 55, 60, 55. Today, if you say successful entrepreneur, successful businessman, rich person, what age would you think of?
No, probably.
You might still think 55, 60, but highly likely even 45, right?
Right.
So the age at which people are earning more money, the age at which people are becoming HNI or prosperous or becoming successful entrepreneurs. I mean, today in India, a lot of billionaires are in their 30s, right? In the US, maybe even lower, right? So the age at which people are becoming prosperous, the age at which people are becoming rich is going down. Any which way, because of demography, on an average, the age of our investors is also going down. So what is happening is that on one side are the professionals and a lot of the people of my generation who are running the affairs of these industry and these service providers. And increasingly, our customers are getting younger and younger. Correct. And now, when I see a lot of commentary happening in the industry, I find that a lot of people say that all these youngsters, they've come in the market after COVID. They have come in because the market is going up. They haven't seen enough volatility. They haven't seen any downside. First hint of trouble, these people are going to run away. They think that market is too easy. So these kind of judgments I see ad nauseum on social media, on television, and in many publications also. Now, my point is that if you are going to see today's youngster with the lens of my youth, now how I reacted if the market fell 20-30% in the late 90s or early 2000s, how I would have reacted if market fell 20-30% was very different from how today's youngster will react, right? Correct. What was the regulation back then? What is the regulation today? The framework is far more sophisticated and totally evolved. It's completely changed. What is the level of education of people? What is the level of prosperity, right? What is the level of risk tolerance, aspirations? It's a different world. It's a different country altogether. If some people have entered the market through COVID, yes, they have seen upside. But it's not like they've not seen volatility. I know for a fact last 4 years, there is at least twice market has fallen 30%. Okay. So, I think that today's youth is not going to panic if market falls 20-30%. I think they're different from what we were 25-30 years back. And that's why I said, the industry, the market is different, technology, regulation are different. But these people are also very different in terms of their risk appetite. And, and by the way, last thing I'll tell you, market falling 20-30% or losing 20-30% in the stock market 25 years back was the equivalent of gambling.
Yeah.
Today, market falling 20-30% and somebody's portfolio being down 20-30%. I mean, on a lighter note, as a stock market, if you lose money, it's a legitimate way of losing money. It's no longer compared with gambling. So, and every generation thinks that the next generation doesn't know enough. But that's not the real history of the world. The history of the world shows that every generation has turned out to be smarter. And that is also part of evolution.
Now, coming to the last question, market corrections and cycles can, they can really test even the most disciplined investors. So what strategies can help them stay focused on India's long-term structural growth story during turbulent times?
See, like I said, never take risk or never expose your portfolio to extremes. We might all be wanting to maximize. But long-term consistent wealth creation is not about maximizing. It is about optimizing. See, maximizing means that put all the money into small caps, put all the money into this latest fad, latest factor or latest sector, and let's maximize. I don't know how much it will maximize, but every once in a while, it will give you such a shock that it will kill your staying power in the market.
Right.
So first is not to get exposed to extremes, not to maximize, only try to optimize. Because optimization helps you stay for long term and helps you be consistently participating in the growth, right? So a fair assessment of how much risk you can tolerate. And like I said, related to the concept I said about maximizing is also what I said, being too deterministic. So don't be too deterministic, be open-minded. Like I said before, yes, Amrit kal aayega, lekin kal subah nahi aayega, and we are not going to get there on a straight line. We are going to go through many ups and downs. And through those ups and downs, you will need to have staying power in the market. If you expose yourself to too much risk, you'll get thrown out. You'll not be able to participate. So I think these thoughts or, these considerations are very important to stay there in the long term.
All right. So don't maximize, optimize, and be open-minded. Well, thank you, Aashish, for sharing your insights and diving deep into your columns with us. We look forward to having you again. Thanks.
Thank you. Thank you very much.